The market's been up and down the last few months. It peaked in January 2025, and there's a lot of concern and worry about where's the market going. And in a short sentence, no one knows. But here are 8 tips I use to manage my nerves and my stock market portfolio going forward. If you're new to my channel, my name is Felicia. I'm a former actuary, property investor, and I retired early. And here I provide educational material to help you to get to that position sooner. Here are my 8 tips. The first one is to look at your risk tolerance. How your ability to withstand the volatility. This is really testing your nerves here. So you're going to decide where is your risk tolerance? Where is it now? Do you feel you can still sleep well at night? And if that's the case, you feel really nervous, you're not sleeping well at night, and all your value of your portfolio is going down. Now is the time to reassess that risk tolerance and say to yourself, well, do I need to change to my portfolio or my plan or my philosophy so that I can still invest in the market and sleep well at night? So that's the first tip, is to go back to the drawing board and assess your risk tolerance and your plans and adjust accordingly. And I'm not saying sell immediately. I'm just saying that you may have in your portfolio investments that isn't quite right, and I think this is testing your nerves here. So I used to be like that until I realised that having a plan, having my philosophy really sort of helps manage my nerves when the market's up and down so choppy at the moment. So check back to your plan, your philosophy, and see if it's still aligned. The companies or the funds you chose are still for and meet your metrics that you the reason why you chose them, and it wasn't just because someone gave you a tip on YouTube or a mate down the pub. The next one is then to look at your different asset allocations. So you look at your portfolio. Is it got the right percentage of equities and stock market type investments and shares? Or has it got enough defensive stocks like treasury bonds or gilts and corporate bonds? And just basically, now it's time to test your nerves and go, does that plan still meet my nerves? Meet my plans for the future? So, for instance, I spoke in previous videos how 5 years or more where you put your money, your hard-earned cash, into the stock market. So that's to anticipate all this volatility. So your things you need now for your emergency fund, they'd actually not be going into the stock market. It should be in a high interest fund or premium bonds. That's what I use. And things like if you're saving towards a deposit for a house or a car or holiday, again, because the market can go up and down and you can lose 10%, 20%, it's not worth putting that money in there. It's for market investment, it's for the long term, 5 years, 10 years into the future. That's then to allow for all this volatility you now see in the stock market since January this year. So the stock market can go down 10%. That's normally referred to as a stock market correction, and you have several of that during the year. And then when it's more than that, it could be so there's a bear market where the market is depressed. So yeah, the stock market is risky, and for potential to have a higher return, you have to take the risk. And so that's why you need to go in there with your plans and prepare for the worst case scenario. And so this is why this all is about financial education, because we all have different needs and different wants, different ages. If you've got, if you're now in retirement and you haven't got your time horizon is not 5 years or more, then maybe you should look at what would satisfy your needs. But if you're young, in your 20s, you've got 20 or 30 years to retirement, you've got more time, you've got more scope to actually then invest in the stock market. So again, this is why it's all about awareness and teaching us to invest, and then invest for your own personal circumstances. The thing to consider is that one only makes a loss when one sells. So if you don't sell, you say the market goes up, you're really happy, you think, oh, you're doing really well with the amazing investors, and then that's called unrealized gains, because it's not, we actually sold that stock or fund to put the capital gain into your bank account. So that's unrealized. Until you take action and sell, you would have realized gains or unrealized losses. So again, bear that in mind. It doesn't really happen until you've sold. So when the market's down, when it's depressed, that's not the right time to start selling. But again, it depends what you bought and why you bought it, and you've got your own risk tolerance. So the best thing, if you've got, again, if you're doing 5 years or longer, is to keep on doing the pound cost averaging, because regular drip feeding into the stock market according to your plans, or according to the funds you've decided to invest in. So consistency, slow and steady wins the race. So that's one point to consider, and also automating that will take the emotional side away from investing. So it's automated. You've got, say you're going to put £100 a month into your preferred stock or funds, then that's automated. It's like direct debit. You don't have to think about it. So in fact, when the market's down, you're getting it at a cheaper rate, at a bargain price, and when the market's higher, of course, it's at a dearer price. So that, again, that's the right time to be investing. But once it's automated, you don't have to start thinking about when to step into the market or when to come out. Automation is key. So yeah, see the volatility as an opportunity, a buying opportunity. So it was the beginning of the year quite, I think it peaked in January this year. Everything was right at the top. Now it's dropped maybe 5-10%. So it's actually cheaper. So your money, the £100 you buy, you can actually buy more units. So the volatility can be a good and bad thing. So let's consider our history. We looked at March 2020 when COVID happened. The market went down in the space of a month by 25%. So was that a good buying opportunity? But it depends if it was still your plan to keep on investing. So if you're investing in that, the market since then has gone up based on the graph on the screen here. So yeah, volatility offers a buying opportunity. But if you're pound cost averaging throughout, then you're buying when the market's low, when the market's high, but over the long term, the market has an upward trend. So looking back, the volatility has, the news headlines saying, the market's crashing, blah, 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 but nobody knows, because they were saying that in 2020, that the market's crashing. It did crash, but then within a few months it went up. So nobody knows, but if you've got your emergency fund sorted out, you've paid off your high interest debt, and then you've sorted out your short-term saving, and you've got time, and you're thinking your time horizon's 5 years or more, then it's better to invest than to save, because over the long term, investment in the stock market does tend to give a higher return on average than inflation, so it beats inflation. So once you've got all the other bits sorted out, your emergency fund, high interest fund, and short-term saving, invest and weather the storm, as they say. So investment is all about having the confidence, having knowledge, having to self-educate yourself, or having a financial advisor to help you along the way, having a group of friends or community to talk about all these things about investment and retirement. So I've got an ebook coming up. And I run workshops on how to get into investing. So comment below the word investing workshop ebook, and that will give you an indication how much demand there is for this. So yes, always, there's other books out there. It's not just my book or my workshops. There's other YouTube channels that are very informative, and also the books I would recommend are books like The Intelligent Investor and also The Bulg Ahead. So all the links I'll leave below of the books I think are quite good to read to help you to educate yourself into this this new world of investing. And also there's in terms of wealth creation, there's other assets as well. It's not just stock market investment. It's always good to be diversified. So have property investment as well, have your own business or your side hustle, invest in yourself, your own education, and build yourself up, your knowledge. And also, like the stock market, it does go up and down. Sometimes you have what we call correlation. So basically, it's like if you're diversified, your returns are averaged out into different slots you have. So yes, it's good to be diversified. So with me, I invested in myself by training to become a qualified actuary, and that I had more knowledge about the stock market and investment and different asset classes. So if there are courses or a mentor, you can pay money to help you, to avoid you making expensive mistakes. That's a good thing. That's self-investment. And also, company in other videos I talk about the pensions, and also diversify. When you got more cash or a small percentage of your money can go into invest into other small companies. and making use of the tax efficiency, for instance, SEIS. So that's a scheme, and that's what I've used. Like, for instance, I've invested in that last year. I invested a small amount into Female Invest, and that's a startup that was had a scheme, an SEIS scheme, and that was a very tax efficient way of getting some of my tax I've paid back into my bank balance. Yes, that's a good thing to have. So yeah, to summarise, the market is very volatile. That's the nature of the beast. So if you have a plan, investment plan, work on that. You have your investment philosophy, and that would actually help you to manage the volatility and the nerves. And thanks for listening to this video. Again, comment below if you've got any questions. I will reply to all the comments below. And if you're interested in the workshop or the ebook, leave a comment below. Again, thanks for listening.